Hello everyone, I'm John Analyst. We need to talk about something that's happening right now in the silver market that most investors are completely missing. While everyone's been distracted by the latest tech stock drama and the Federal Reserve's rate decisions, a fundamental shift in silver demand has been accelerating. And if you're not paying attention to this, you're going to be caught completely off guard when this market moves. What I'm about to show you isn't speculation. It's happening in real time, documented in industrial reports, mining data, and supply chain analysis. And the implications for silver prices over the next 18 to 24 months are significant. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. This channel, The Silver Reset, exists specifically to break down these structural changes before they become obvious to the mainstream. And right now, we're watching something extraordinary unfold in the data center sector that's going to reshape silver demand in ways that haven't been priced into this market yet. Let me start with the basics, because understanding this requires looking at what's actually happening in the industrial economy. Silver isn't just a precious metal. It's not just an inflation hedge or a store of value. Silver is the most electrically conductive metal on the planet. It's the most thermally conductive. It's ductile, it's malleable, and it doesn't corrode easily. These aren't marketing talking points. These are physical properties that make silver irreplaceable in high-performance electrical applications. And that's where the story begins. The artificial intelligence boom that started gaining serious momentum in early 2023 has created an unprecedented demand surge for data center infrastructure. We're not talking about incremental growth here. We're talking about a fundamental expansion in computing capacity that requires physical infrastructure at a scale most people don't comprehend. Every AI model, every large language processing system, every machine learning application runs on servers. And those servers require power distribution systems, cooling systems, networking equipment, and backup power infrastructure. All of that requires silver. Now let me walk you through the numbers because this is where it gets interesting. A typical enterprise-grade server uses approximately 1 to 2 grams of silver in its electrical contacts, switches, and circuit boards. That doesn't sound like much. But when you're talking about hyperscale data centers that house 50,000 to 100,000 servers, you're suddenly looking at 50 to 200 kilograms of silver per facility. And here's the critical part. The major tech companies aren't building 1 or 2 of these facilities. They're building dozens. Microsoft announced plans in late 2023 for multiple new data center campuses. Google has been expanding its data center footprint aggressively. Amazon Web Services continues to add capacity globally. Meta is building AI-specific infrastructure. And this doesn't even include the Chinese tech giants, the emerging AI companies, or the enterprise customers building their own private cloud infrastructure. But here's where it becomes important. The demand from data centers isn't seasonal. It's not cyclical in the traditional sense. Once these facilities are built, they operate continuously. And as AI applications become more embedded in business operations, consumer technology, and industrial systems, the computational load doesn't decrease, it increases, which means the silver that goes into this infrastructure isn't coming back into the market. It's locked into long-term industrial use, and that creates a permanent demand base that didn't exist 5 years ago. Now notice what changed in the silver market starting in mid-2023. We saw price volatility increase. We saw unusual trading patterns in the futures markets. We saw deliverable silver inventories at the COMEX start to show stress. But the mainstream financial media kept treating silver like it was just another commodity responding to dollar strength or rate expectations. They missed the structural story completely. And that's the opportunity, because when a market is mispricing a fundamental demand shift, that's when you get asymmetric return potential. Look closely at this trend. The Silver Institute's industrial demand data showed fabrication demand for silver in the electronics sector grew by approximately 8% year over year in 2023. That's the highest growth rate in that category in over a decade. And the preliminary data for 2024 suggests that growth is accelerating. Now, you might think 8% doesn't sound dramatic, but when you're talking about a market that consumes roughly 500 million ounces of silver annually for industrial applications, an 8% increase represents 40 million additional ounces of demand. That's more than the entire annual production of Peru, the world's second largest silver producer. And here's what makes this particularly significant. Silver mining is incredibly inelastic in the short term. You can't just decide to produce more silver next month because demand increased. Opening a new mine takes 5 to 7 years minimum. Expanding existing operations requires capital investment, permitting, infrastructure development, and operational scaling. And here's the reality that most investors don't understand. Roughly 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. That means silver supply is largely determined by the economics of those base metals, not by silver prices alone. So what happens when you have accelerating demand from a completely new industrial application, meeting a supply base that can't respond quickly? You get tightness, you get volatility, you get a market that's structurally positioned for a significant repricing. And we're seeing early evidence of this in the physical market right now. Premiums for physical silver bars and coins have been elevated for months. Delivery times for major refineries have extended, and the spread between paper silver prices on the futures exchanges and physical silver in the retail market has widened noticeably. But let me explain why the data center angle is more significant than just another source of industrial demand. This is about the intersection of multiple megatrends. You have the AI revolution, which is still in its early innings. You have the global push toward renewable energy, which also requires massive amounts of silver for solar panels and electrical infrastructure. You have electric vehicle adoption, which uses silver in electrical systems, charging infrastructure, and battery management systems. And you have the broader electrification of everything from industrial equipment to consumer appliances. All of these trends are happening simultaneously, and they're all silver intensive. Now here's where the financial dynamics become critical. Silver has historically traded with a strong correlation to gold, but with significantly higher volatility. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 65 over the past century, but that ratio has been as low as 15 during periods of industrial demand surges and as high as 120 during financial crises. Right now, as I'm recording this, the ratio is hovering in the mid to upper 70s range. That suggests silver is undervalued relative to gold based on historical patterns, but more importantly, it suggests the market hasn't priced in the structural demand changes we've been discussing. Let me walk you through what happened the last time we saw a major industrial demand shift in the silver market. In the early 2000s, the rise of digital photography and early electronics manufacturing created a significant new demand base for silver. Between 2000 and 2011, silver prices went from roughly $5 per ounce to nearly $50 per ounce. Now, I'm not predicting a 10 times move. I'm not making price targets. But I am pointing out that when silver's industrial demand fundamentals shift meaningfully, the market response can be substantial and sustained. And here's what's different this time. The data center build-out is happening at a much faster pace than the electronics revolution of the 2000s. Companies are investing hundreds of billions of dollars into AI infrastructure right now. Microsoft announced a $60 billion capital expenditure plan for fiscal 2025, with the majority allocated to data centers and AI infrastructure. Alphabet is spending similar amounts. Amazon's capital expenditures have been running over $50 billion annually, much of it on AWS infrastructure. This isn't speculative venture capital money. This is committed infrastructure spending from some of the largest, most profitable companies in the world. Now let's talk about the supply side, because this is where the story gets more complicated. Global silver mine production has been essentially flat for the past 5 years. We're producing roughly 850 to 900 million ounces of silver annually from mining. That number hasn't grown meaningfully despite silver prices being significantly higher than they were a decade ago. Why? Because the easy silver deposits have been mined. The high-grade deposits that could produce silver profitably at $15 or $20 an ounce are largely exhausted. New deposits tend to be lower grade, more geologically complex, located in more challenging jurisdictions, and more expensive to develop. And there's another factor that doesn't get enough attention. Silver mining is increasingly facing environmental and permitting challenges. New mine development in North America and Europe faces significant regulatory hurdles. Projects that might have been approved in a year or two in the past now take 5 to 10 years to get through the permitting process. And even in more mining-friendly jurisdictions, social opposition, environmental concerns, and indigenous rights issues can delay or block projects entirely. So you have demand that's accelerating from multiple sources simultaneously, and you have supply that's structurally constrained and can't respond quickly. In any other market, that would be considered a setup for a significant price move. But silver is different because of the futures market dynamics and the role of financial speculators. The paper market for silver, traded on exchanges like the COMEX, is many times larger than the physical market. And that creates price discovery mechanisms that can diverge from physical fundamentals for extended periods. But here's where it becomes important. At some point, physical demand overwhelms paper market positioning. We saw this happen in the nickel market in 2022, when the London Metal Exchange had to halt trading because physical shortages made the futures market untenable. We've seen it in other commodity markets when financial positioning becomes disconnected from physical reality. And while I'm not predicting a market dislocation in silver, I am saying the gap between physical fundamentals and paper market pricing is widening. Let me show you what I mean. Look at the silver ETF flows over the past 18 months. The largest silver ETFs have seen significant inflows during periods of financial market stress. Investors are allocating to silver as an inflation hedge, as a monetary alternative, as a portfolio diversifier. But those flows have been relatively modest compared to the industrial demand we're discussing. The iShares Silver Trust, the largest silver ETF, holds roughly 450 million ounces. That's significant, but it's less than half of annual industrial consumption. And when you consider that data center demand alone could be adding 30 to 50 million ounces of incremental demand annually, you start to see how the market balance could shift quickly. Now let's talk about what this means for inflation and monetary dynamics, because that's where silver's dual nature becomes critical. Silver is both an industrial commodity and a monetary metal. It's been used as money for thousands of years. And while it's not formally part of the monetary system today, it still functions as a store of value and an inflation hedge for millions of investors globally. So when you have accelerating industrial demand meeting constrained supply, and you layer on top of that concerns about currency debasement, deficit spending, and inflation, you get a very interesting setup. The Federal Reserve's monetary policy over the past 4 years has been extraordinary by historical standards. We had zero interest rates, massive quantitative easing, direct fiscal stimulus, and an expansion of the Fed's balance sheet to nearly $9 trillion at its peak. Even with the rate hikes of 2022 through 2024, real interest rates, adjusted for inflation, have been negative or barely positive for much of this period. And that environment has historically been very favorable for precious metals. But here's what changed in 2024 and into 2025. Inflation proved more persistent than the Fed expected. Core inflation has been sticky. And while headline CPI numbers have moderated from their peaks, the inflation expectations of businesses and consumers have become less anchored. That creates a challenging environment for the Fed. They can't cut rates aggressively without risking a resurgence in inflation. But they can't keep rates highly restrictive without risking recession. And that uncertainty, that lack of clear monetary policy direction, creates demand for alternative stores of value. Silver benefits from this in a unique way. Unlike gold, which is primarily a monetary metal, silver has industrial utility that supports its price floor. But, like gold, it has monetary characteristics that attract investment during periods of currency uncertainty. So you get dual support for prices. Industrial demand provides a baseline, monetary demand provides upside leverage. And when both are working simultaneously, which is what we're seeing now, the price dynamics can become very favorable. Now notice what's happened with mining equity valuations. Silver mining stocks have been remarkably undervalued relative to the metal price for the past 2 years. The NYSE ARCA Silver Miners Index has underperformed spot silver significantly. That suggests the market is pricing in either declining silver prices or operational challenges for miners. But the operational data doesn't support that bearish view. Many primary silver miners are reporting strong cash flows, manageable costs, and improving production profiles, so why the valuation discount? Part of it is general skepticism about commodity equities. Part of it is concern about jurisdiction risk, particularly for miners operating in Latin America. Part of it is the overhang of dilution from past equity raises when silver prices were lower. But part of it, and I think this is significant, is simply that the market hasn't recognized the structural demand shift we've been discussing. When that recognition comes, and it will come eventually, you're likely to see a significant revaluation of mining equities. Let me explain what this means for investor behavior and positioning. Right now, institutional investors are underweight commodities, generally and silver specifically. The typical pension fund or endowment has minimal exposure to physical commodities. And within commodity allocations, silver is usually a small position if it's held at all. But if the industrial demand story we've been outlining becomes part of the mainstream investment narrative, that could change quickly. You could see institutional allocations shift. You could see commodity trading advisors increase their silver positions. You could see retail investors respond to the story through ETF purchases. And here's the kicker. The silver market is relatively small in financial terms. The total value of all above-ground silver available for investment is roughly $50 billion. That sounds like a lot, but it's less than the market cap of many individual tech companies. It's a tiny fraction of the bond market or equity markets. So when large pools of capital decide to allocate to silver, even small percentage moves create significant price impacts because the market can't absorb large inflows without moving substantially. Think about what happened in early 2021 during the Reddit-driven silver squeeze attempt. Retail investors became interested in silver for about 2 weeks. The price spiked from roughly $25 to nearly $30 in days. Physical premiums exploded. Dealers ran out of inventory. And that was from a relatively small amount of retail buying. Now imagine what happens if institutional investors, who manage trillions in assets, decide silver is an attractive inflation hedge or industrial commodity exposure. The price discovery process could become very interesting very quickly. But let's bring this back to the data center story, because that's the concrete, verifiable trend we can track. The build-out of AI infrastructure is not speculation. It's happening right now. You can track construction permits, capital expenditure announcements, power grid connection requests, and real estate transactions. Microsoft has data center projects underway in Virginia, Iowa, Arizona, Texas, and multiple international locations. Google is expanding in South Carolina, Tennessee, and Nevada. Amazon is building across the Midwest and Southeast. This is billions of dollars of committed infrastructure spending that will require millions of ounces of silver over the next 3 to 5 years. And it's not just the hyperscale cloud providers. Enterprise companies are building out their own AI infrastructure. Financial services firms are deploying AI for risk management, trading, and customer service. Healthcare organizations are implementing AI for diagnostics and research. Manufacturing companies are using AI for quality control and process optimization. All of this requires compute infrastructure. All of it requires data centers. All of it requires silver. Now let's talk about the cooling systems, because this is an aspect that doesn't get enough attention. Data centers generate enormous amounts of heat, and as chip densities increase and AI workloads become more computationally intensive, cooling becomes more critical. Advanced cooling systems use silver-based thermal interface materials, silver-lined heat exchangers, and silver-coated electrical components specifically because of silver's superior thermal conductivity. As data centers shift to liquid cooling and more sophisticated thermal management systems to handle AI workloads, The silver intensity per server actually increases. I want you to understand the scale we're talking about here. A large AI training cluster might consume 50 to 100 megawatts of power. That's roughly equivalent to a small city. And all that power has to be distributed, managed, backed up, and converted from AC to DC multiple times. Every transformer, every switchgear assembly, every power distribution unit, every uninterruptible power supply uses silver contacts and components. The electrical infrastructure required to support these facilities is massive, and it's all silver intensive. Here's where the investment implications become clear. We're in the early stages of what could be a multi-year cycle of data center construction and expansion. The AI revolution is not a 6-month story. It's a fundamental shift in how computing infrastructure is architected and deployed. And that means the silver demand from this sector is not a spike that will fade. It's a structural elevation of the baseline demand curve that will persist for years. And remember, this is happening while other silver demand sources are also growing. Solar panel installations globally are accelerating as countries push toward renewable energy targets. Silver paste is a critical component in photovoltaic cells, and there's no cost-effective substitute at current performance levels. Electric vehicle production continues to grow, and EVs use roughly twice as much silver as internal combustion vehicles. 5G infrastructure rollout requires silver in base stations and network equipment. The electrification of industrial equipment, from motors to control systems, is increasing silver usage across manufacturing sectors. All of these trends are proceeding simultaneously, and they're all competing for the same constrained silver supply. Now think about what that means for pricing dynamics over the next 18 to 24 months. If industrial demand continues growing at current rates and mining supply remains flat or grows only marginally, something has to give. Either prices rise to incentivize new supply and ration demand, or we see actual physical shortages in certain applications. Let me walk you through what shortage conditions might look like, because this isn't hypothetical. In early 2024, certain silver products experienced extended delivery times. Refiners were quoting 6 to 8 week lead times for large orders that previously would have shipped in days. Industrial buyers reported difficulty sourcing specific silver alloys and forms. These weren't widespread shortages, but they were early warning signs of a market that's tightening. And here's what makes this particularly important for investors. The silver market has a history of explosive moves when physical tightness emerges. In 1979 to 1980, silver went from $6 to $50 in months. In 2010 to 2011, it went from $17 to $48 in about a year. These weren't gradual trends. They were sharp, powerful moves, driven by a combination of physical demand, financial speculation, and momentum. And while I'm not predicting a repeat of those specific events, I'm pointing out that silver's market structure makes it prone to significant volatility when fundamentals shift. Now let's discuss the role of recycling, because this is often cited as a source of supply that can meet increased demand. And it's true that silver is recycled from industrial applications, jewelry, photography, and other sources. Global silver recycling runs roughly 150 to 180 million ounces annually. But here's the reality. Recycling is price sensitive. At higher prices, more recycling occurs. But there are limits. The silver embedded in electronics is often present in such small quantities that recovery is not economical unless prices are very high. The silver in solar panels won't be recovered for 20 to 25 years when those panels reach end of life. The silver in data center infrastructure is locked in for the operational life of that equipment, which could be 5 to 10 years or longer. So recycling can provide marginal additional supply, but it's not a magic solution that can offset major demand increases. And the more silver that gets locked into long-term industrial applications like solar panels and data centers, the less available recycling supply there will be in the medium term. Here's another angle that doesn't get discussed enough. Silver's role in the renewable energy transition goes beyond just solar panels. Grid-scale energy storage systems, which are essential for managing intermittent renewable power sources, use significant amounts of silver in their electrical components. Wind turbines use silver in their electrical systems and control equipment. The transmission infrastructure required to move renewable power from generation sites to consumption centers uses silver in switching equipment and power electronics. As countries around the world commit to net zero targets and accelerate renewable energy deployment, the silver intensity of the global electrical infrastructure is increasing. This is a multi-decade trend that's just beginning, and it's happening at the same time as the electrification of transportation and the build-out of AI infrastructure. These are not competing trends. They're reinforcing trends that all point in the same direction towards structurally higher silver demand. Now, let's bring this back to market psychology and investor positioning. One of the most interesting aspects of the current silver market is how few people are paying attention to these fundamental shifts. If you read mainstream financial media coverage of commodities, it's mostly about oil and copper. Silver gets mentioned occasionally in the context of precious metals or inflation hedging, but the industrial demand story is largely ignored. And that disconnect between what's actually happening in the physical market and what investors are focused on creates opportunity. Think about how markets work. Prices adjust to bring supply and demand into balance. When demand exceeds supply, prices rise until demand is rationed or new supply is incentivized. We're seeing the early stages of that process in silver right now. Prices have been relatively range-bound between $22 and $30 for the past couple of years, but the physical market fundamentals have been tightening consistently. At some point, price has to adjust to reflect that reality. The only question is timing and magnitude. And here's what makes the timing aspect particularly interesting. The Federal Reserve's rate policy creates a framework for when that adjustment might accelerate. If the Fed is forced to cut rates due to economic weakness, real interest rates fall, and precious metals typically benefit. If the Fed keeps rates elevated but inflation remains persistent, real rates stay low, and metals benefit from inflation hedging demand. Either scenario is potentially favorable for silver. The unfavorable scenario would be the Fed successfully achieving 2% inflation while maintaining strong economic growth, allowing them to keep real rates positive. That's the soft landing scenario everyone hopes for. But the economic data suggests it's becoming increasingly difficult to achieve. Let me explain why the current economic environment is particularly supportive for silver from a monetary perspective. We have over $35 trillion in federal debt. We're running trillion-dollar-plus deficits annually, even during periods of economic expansion. Debt service costs are approaching $1 trillion per year. And the political appetite for meaningful deficit reduction is essentially zero. That fiscal trajectory raises legitimate questions about the long-term purchasing power of the dollar. Now, I'm not making apocalyptic predictions about currency collapse. I'm simply pointing out that when investors become concerned about fiscal sustainability and currency debasement, they allocate to hard assets. Gold is the traditional play for that thesis, but silver offers similar monetary characteristics, with the added benefit of industrial demand support. And for investors who believe the monetary argument but find gold expensive at current levels, silver offers more affordable entry points and potentially more upside leverage. The gold-silver ratio is useful here. When that ratio is elevated, meaning you need a lot of silver ounces to buy 1 gold ounce, silver is cheap relative to gold. When the ratio compresses, meaning fewer silver ounces buy 1 gold ounce, silver is expensive relative to gold. Historically, when monetary concerns drive precious metals higher, the gold-silver ratio tends to compress significantly. In the late 1970s, it got down to 15. In 2011, it briefly touched 30. Right now, it's in the mid-70s. If we see another precious metals bull market driven by monetary concerns, and the industrial demand story we've been discussing is layered on top of that, you could see substantial ratio compression. What does that mean in practical terms? If gold goes to $3,000 an ounce and the gold-silver ratio compresses to 50, silver would be at $60. If the ratio compresses to 40, silver would be at $75. These aren't predictions, they're scenarios illustrating the mathematical relationship. The point is that silver has leverage to gold moves. And when its own industrial fundamentals are also positive, that leverage can be substantial. Now let's talk about what smart money is doing. And by smart money, I mean the investors and institutions that have been consistently right about major market moves over the past decade. Several prominent macro investors have been increasing their commodity allocations. Hedge funds that focus on real assets have been building positions in precious metals and miners. Family offices are allocating more to physical bullion. These aren't people chasing momentum. These are sophisticated investors, making strategic allocations based on their assessment of macro trends and market positioning. And what are they seeing? They're seeing the same fundamental shifts we've been discussing. Accelerating industrial demand, constrained supply, attractive valuations in mining equities, a macro environment that's supportive for inflation hedging, and market positioning that's relatively light, meaning there's room for significant inflows if the narrative catches on more broadly. Here's where the channel, the Silver Reset, provides value. We track these developments in real time. We analyze the supply-demand fundamentals. We monitor the financial market positioning. We watch the macro environment. And we try to identify the inflection points before they become obvious to everyone else. Because by the time something is obvious, the easy money has already been made. The opportunity is in identifying structural shifts early and positioning before the broader market recognizes what's happening. So what should you be watching going forward? First, track the capital expenditure announcements from major tech companies. When Microsoft, Google, Amazon, and Meta report their quarterly results, pay attention to what they're saying about infrastructure spending and data center expansion. That will give you visibility into the pace of AI build-out and the associated silver demand. Second, watch the industrial demand data from the Silver Institute and other industry sources. They publish regular reports on fabrication demand by sector. You want to see if the electronics and electrical applications categories continue to grow. Third, monitor mining supply data. If we start to see production declines or project delays, that's a signal that supply constraints are getting worse. Fourth, track the physical market premiums and delivery times. If those continue to widen, that's evidence of tightening physical conditions. And fifth, watch the price action and market positioning. If silver starts to break above its recent trading range and hold those gains, that could signal that the market is beginning to price in the fundamental changes we've been discussing. If we see sustained inflows into silver ETFs, that tells you retail and institutional interest is building. If mining stocks start to outperform the metal, that suggests investors are getting more optimistic about the sector's prospects. But remember, markets don't move in straight lines. There will be volatility, there will be pullbacks, there will be periods where the narrative is questioned and positions are tested. That's normal. What matters is whether the underlying fundamentals remain intact. And based on everything we've examined, the data center demand story is real, it's accelerating, and it's creating a structural shift in the silver market. that hasn't been fully priced in yet. Let me bring this to a conclusion with some broader context. We're living through a period of extraordinary technological change. Artificial intelligence is not hype. It's a fundamental advancement that's going to reshape industries, economies, and societies. But that transformation requires physical infrastructure. It requires energy, it requires materials, and one of those critical materials is silver. The same metal that's been used as money for 5,000 years is now essential to building the computational infrastructure of the future. That duality is what makes silver so compelling as an investment thesis right now. You have the traditional monetary demand, which is always present but becomes more intense during periods of fiscal and monetary uncertainty. And you have this new accelerating industrial demand from AI infrastructure, renewable energy, electrification, and advanced electronics. Those two demand sources are working together, putting pressure on a supply base that can't expand quickly. The setup is there, the fundamentals are there, the catalysts are there. What's missing is broad market recognition. And that's where the opportunity exists. Because when that recognition comes, when the narrative shifts, when institutions start allocating, when retail investors get interested, the price adjustment could be significant and sustained. Thanks for watching. Subscribe to the Silver Reset, share this analysis with anyone you think should see it, and stay alert. Because what's happening in the silver market right now, driven by the infrastructure demands of artificial intelligence and the broader technological transformation we're living through, matters more than most people realize. The data centers being built today are locking in silver demand for years to come. The solar panels being installed are creating permanent demand. The electric vehicles being manufactured require silver in their electrical systems. These aren't temporary trends. They're structural changes to the industrial economy. And silver sits at the center of all of them. Stay informed, watch the data, and understand that the market dynamics in silver are shifting in ways that create asymmetric opportunity for those paying attention.